What's up everyone, Money Central here, and I hope everyone's having a great day as always. We had a crazy week in the financial world this week. The Federal Reserve just raised interest rates by 25 basis points following its March 21st and March 22nd meeting this week, bumping the federal funds rate to between 4.5% and 5%. And this is kind of crazy because with these 25 basis points, we are now sitting at higher interest rates than in 2007, right before the Great Recession. Jerome Powell and the Feds also announced that they're not done yet, so be sure to stick around to see what else is coming. All I ask is that you hit that subscribe button and like this video. It helps me out tremendously. I know. A lot of us have been going to the grocery store for the last year or so, and every time we finish checking out, we look at our grocery bill and we wonder why the heck is it so high. And as the Feds are sitting here telling us that things are getting better and we're having a more positive outlook on things, people are starting to question, is that really the case? Well, let's first start by talking about inflation. Last year in 2022, the Federal Reserve raised interest rates higher than they ever have before. But since inflation's 9.1% peak in June of 2022, in February of 2023, it was at 6%, dropping nearly 33% since last year's highs. Now, while a lot of people are sitting here thinking and hoping that we'll be sub 5% inflation by the end of the year, well, that may not be the case. So the big question right now from a lot of investors is how much will the Feds raise rates going forward? Well, this past week we were told by the Feds that they only plan on raking hikes one more time this year. But let's be honest, nobody can really predict that. It's all going to come down to the numbers and data that comes out throughout the rest of this year. The scary thing is the Feds aren't only raising interest rates, they're also selling off huge chunks of their bonds portfolio. The big question is, why are they doing this? Well, they're doing this to run off their balance sheet so that they can help slow down inflation. Now let's take a look at the Personal Consumption Expenditures Index, which is actually the Fed's favorite tool for calculating inflation. The PCE was actually up to 4.7% in January of this year compared to 4.6% in December of last year, with its highest peak in June of 2022 at 5.3%. The Feds also announced that they believe normal inflation is when the core PCE is around 2%. So what is the Fed's outlook going forward in their fight to curb inflation? As I said earlier, the Feds plan on raking hikes one more time this year, and they plan on that being 25 basis points in their next meeting on May 3rd. However, there's a lot of economic data coming out over the next 6 weeks that could change that number. Many investors believe that rate hikes will start to slow down going forward, but let's be honest. We never know what's going to happen in this economy. Let me know your outlook going forward and what you think the Feds will do in the next meeting in the comments below. Thank you for watching, and I hope everyone has an amazing and safe weekend, and I'll see y'all in the next video.